You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back to kick off the new year, the mad, insane, fun year that will be 2023. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we tend to think so, Options Insider Radio Network. I want to thank all of you out there who were a part of just the craziest, the wildest, the most explosive year by far in the history of the network, which now in January is celebrating our 16-year anniversary, which is just terrifying to say out loud. We'll have to schedule some sort of big party, some big soiree to celebrate 16 years, kicking off the options podcast scene all the way to what it has become today. It's been quite the wild ride. Thank you to all of you who have been part of it along the way. We literally couldn't do it without all of you guys and gals out there. So thanks to all of you out there. Of course, if you do like what you hear and you're new to the show, maybe you've been listening for a while, you like what you hear, and you're on the on-demand side, do keep rating and reviewing. It clearly does help new people discover the content out there. And of course, if you want to go above and beyond, you want to join us for more great exclusive pro content for a lot of you advisors out there. A lot of you have questions about how to utilize these products. Well, luckily for you, we have great pro Q&A sessions, as well as other great content, all available over there on our exclusive pro podcast feed, theoptionsinsider.com/pro. So if you have questions, you should definitely be checking out that link, because It's a place to get your questions answered by some of the best minds in the world of options and derivatives. Joining me to kick off the year, speaking of one of the best minds out there, to parse these products and just cut through the madness and see what's going on in the world of options for a brand spanking new year 2023. I am pleased to be joined once again by my compatriot in all things advisors option crime, Mr. Matt Amberson, the principal and founder over there at ORATS, aka Options Research and Technology Services, even though we call him around here the Oracle of New Hampshire. Mr. Matt, welcome back to the Advisors Option and Happy New Year to you, sir.
Happy New Year, Mark. It's a time to look back, and of course, you and I were on the floor of the SIBO in the 90s. I started at Lehman Brothers back in the 80s. That was my first trek to downtown Los Angeles and getting into the finance and seeing how the stocks work, and it was pretty crazy. So I've seen a lot of markets, and I think the people are going to get a lot out of it, especially with options. Especially, I think things are a change in here. I think we're going to enter a bear market, or at least a market that's going to be down quite a bit. Who knows if it's prolonged, but I think it's going to be a lot different. So you're going to need to utilize all the faculties, including options, so it's going to be a minefield, but we'll help you get through it. Thanks for being here, Mark. Thanks for having me on, and looking forward to a profitable we've been busy too. Another good year.
Well, you certainly get pride of place this year, Matt. You are our first guest on our first ever program for the new year. So how's that, sir, for a prominent position to kick off the new year?
I think I was the last one too.
You were. You bookended the last year and kicked off the new year. So there you go. Pride of place for Mr. Matt as we keep on rolling and kick off 2022 with our first ever P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement. The segment, as I mentioned before, that was born out of the pandemic because we spent so much time just discussing what the heck happened over the past month, because usually something crazy and unprecedented has happened since our last show. So we spent a lot of time talking about it, hence the launch of this segment. But as Matt alluded to, we are kicking off the new year, so we're going to do a little bit of a different P&L statement because it was such a mad, insane, topsy-turvy year. I was kind of joking at the top of the show. It's going to be another one of those. I don't think anyone is hoping for another mad, insane topsy-turvy. I think we could all use a dose of normalcy, a dose of quiet, a dose of calm in the markets, in the world as a whole. We've been hoping ever since 2020, maybe 2021 would be the year. Nope. Kicked off with just an insane, tumultuous bang. 2022 said, hold my bear. So let's hope. So far, the new year has begun. So far, there haven't been any insurrections or invasions or any other sort of crazy, just horrible news. So that's a good thing for the first day. The markets are not liking how things are commencing. S&P off nearly a full % as we're kicking off the show here on the first trading day of the new year. Once again, January 3rd, listeners. The NASDAQ off about 1.25% and the Dow off about close to 0.75%. So anyone who was hoping for the old, funds got to get back in to start the new year, bye. At least for right now, not happening. Hanging out right around the 3,800 level again in the S&P. Matt, we'll get to all the current stuff in a second. But first, it's our first show of the new year, literally in the case of the Advisors Option, because it's the first show we're putting out on the network for the new year. So let's start looking back a little bit here. It was a crazy year, as I alluded to. What stands out to you when you look back at the year that was from an options perspective? What were the major trends or developments or trades, or what really resonates to you from 2022 from an options and indeed vol perspective?
Well, I think you have to go first to the every day is an expiration. And I think that does affect the market. More volatility in some ways. I remember as a market maker, we used to love, and also because we used to make a lot of money on expiration because everyone was rolling stuff, but also it was so busy you were just completely exhausted by the end of the day. And so we have every day could be an exhaustive day now. So I think really that's one of the bigger things that happen. And then I think just the turning, the bear has turned to the bull is done. I think for a while, what you're seeing is, I think a well, I don't want to say orchestrated, but you're going to have a higher standing level resting volatility in a bear market, but the down moves aren't going to be, and there's so many people that kind of are predicting it and positioned well for it, that actually what's happening is, after a move down, you're getting people coming in selling some of the puts that they're long. Whereas in the bull market that was before, if you ever got a down move, it would be like a shock to those people, almost like a squeeze, and they'd have to panic buy. Now people are selling some of their protection into it. So I think that's been the big change that I've noticed for me. And really what you need to do is I think change a lot of the assumptions that you have for the hedges. And, of course, at ORAS, we're big on hedging your position. And, before we used to just do these way out of the money puts, garbage puts, some people call them, but they work pretty well. They didn't decay very much. And then when the market went down, they exploded because of vol. They're not exploding that much anymore. So you have to take some different approaches to it. Which we could talk about if we want. But, I think those are the two biggest things. That and earnings is going to be a much bigger part of the equation now. The guidance is going to be something. I think, interest rates, the volatility is going to come down a little bit in interest rates, since I think the Fed will probably pause for a bit now. We'll probably see a recession coming up. But, looking back, I think we're now pretty solidly in a bear market downtrend. We have the dailies that have made it very interesting and some good things to look at as far from a volatility perspective. And earnings are going to be more important to look at, and it's going to, I think it's going to create a lot of volatility going forward. So those are my themes, Mark, from 2022 and how it's going to impact going forward into 2023.
So you're telling me 2023 is no longer going to be the year of garbage? 2022, we saw everybody love garbage mixed calls, garbage SPY puts. You're saying no more for garbage in 2023, Matt?
No more garbage. We're all recycling now.
The year of recycling. Might be recycling some of our assets if these sell-offs keep up. But you mentioned another point I wanted to hit on, Matt, which is kind of inescapable. If I had told you, Matt, this time last year, our first show of the new year last year, and I said, guess what? 2022 is going to be the year where retail doesn't just flock en masse to the SPX, which is notoriously not a retail-friendly product. But retail is going to flock to it this year. And guess what? They're going to be diving in expiration day every day, just nonstop, crazy rolling of the dice every day in the SPX. And people are going to love it. And not just retail, big funds, too, are going to be playing when the stakes are the highest, you could say, when expiration is every day. You probably would have called me a madman, sir. And you would have been right, but here we are a year later, and that's what we're seeing in the SPX. It's just crazy town, man.
Yeah, but I think there's a lot more nuance to it. People are figuring out other things to look at. Then, it's not just, 1 day's left. It's just a total gamble. There are a lot more things to look at, and people are looking at them. And the time frame has become a lot more focused. So, for example, we have 1 minute implied volatilities, 1 minute contangos, and people are watching those. And we have signals that come up that they fire off. And when three things happen, you could send a trade. So people are becoming a lot more sophisticated, especially retail. And plus, you don't have you don't have to hold it overnight. You don't have to hold a position overnight. You could, with a spread, you could set the amount of risk you want to take. The options are actually cheaper since they're only 1 day. And I think that you have more of a par of information with, since it is so binary, that retail could actually compete a little bit better on that last day. So, I think everyone's kind of learning it together on what to do. And so then you also have, there's so much volume that people are watching, where the trade is, where are people, what strikes are people buying, what strikes are people selling, how does that affect the movements, and doing a lot with that, doing a lot with even trends in the one day using minute bars. And so there's a lot going on that it's not just a gamble, it's actually pretty sophisticated, and I think it's actually quite good for the market overall. You're seeing people valuing risk, which is what we do, which is the value of what we're doing. And one of the most important parts of an economy is how you price risk. And we're doing that now on an intraday basis. And some of the studies that we do are, what is the implied move, like we look at for earnings, but what's the implied move for the 2:30 the 2:30 announcement from the Fed, from the press release. So we're starting to get down to that granularity, and I think it's a good thing. I think it's good for the economy to know these things, for investors to be able to protect themselves. Even long-term investors, I think it actually has a beneficial effect. So, it's not just the casino. It's people are really doing a ton of research, and I think the research is important for an economy, Mark.
Yeah, strangely enough, we are talking about this on our first show of the year, which is the advisor's option. If there's one audience on the network that will probably, I would think, engage with these zero DTE options, it probably is the advisor and asset manager audience. The one complaint we've heard about using options from this audience, Matt, since we launched this show, since the early days, has been, I just don't have time for that. I don't have time to put on a put and babysit it and maybe roll it and adjust it, or do the same thing with a covered call or a collar. I have too many clients. I have too many things I need to do. I'm always doing calls and taking meetings and adjusting positions. I don't have time to add the options layer on top of it. So time management has always been a key obstacle for this audience. So I don't see them, Matt. I don't see them diving into the fray and going hardcore on the zero DTE trend. But then again, I've been surprised just about every year so far since the pandemic. So I won't write anything off at this point. Everything is on the table. But I would be very surprised, let me put it, Matt, if the audience for this show, the advisors and asset managers, if they dove deeply and heartily into the zero DTE frame. Matt, what about you?
Well, that's a good point. But, in order for you to be a good advisor, you need to have all the tools. And this is definitely one big tool that people, expect you to at least have knowledge of and be able to accomplish certain of your clients' goals. So you're going to have to know that. Now, there are a few ways to do it. I mean, one is, there are some, you could offload it. There are some, Spider Rock Advisor types that can take some trading off for you. There's automation, Option Alpha, and indeed what we're doing. You could automate some of the exits, for example, that you get in, and even we're getting towards automating entries and exits. But obviously that has some risk implied. But also, you need to start automating more of the strategies that you can offer your clients, and the firms that are going to be able to do that are going to be the ones that are going to attract the type of people that want all of the differing option strategies toolbox offered to them. This is there's a lot of opportunities in one day. There's a huge amount of trading going on. So I agree it's difficult, but there is also automation and help out there. So you can't turn a blind eye to it. You could learn it. I've been trading a lot more expiration day type stuff and putting some automations in for exit. So, I think it's going to move towards the advisors, and I think the customers are going to push them that way, Mark.
Well, there certainly is truth to that. If you want to attract the bleeding edge of the options audience as an advisor, then you are going to obviously have some overlap. People are going to come into your office and say, hey, have you heard about these things? They're kind of interesting. So you have to at least be aware of them as an advisor. You have to at least have your talking points in place for when someone asks you about these, even if you're not going to use them. And who knows, over time, you see more and more demand. Maybe getting back to what Matt was talking about with the automations, maybe you find some ways to utilize these in your portfolio. They are interesting tools. They certainly do offer a new array of options. I have said this before. I think looking ahead at 2023, one of the interesting questions I will have is, how will this explosion of zero DTE options, how will this impact everything else? Right now, it's limited to the SPX, probably will be limited to the major indices for a while. I've talked to the folks at OCC. They don't seem to be in a great hurry to move this to the single names you guys love to trade, like your Apples and your Teslas and your Facebooks and all that fun stuff. For obvious reasons, there are many inherent risks in a single name that aren't present. And in equity, you could have a surprise corporate action. You, of course, have earnings on a quarterly basis. You could have surprise dividends, all these things that don't really happen in an index. So it's much harder to model those daily expirations when you throw in all those other risks. I don't think OCC is quite ready for that yet. So I don't think we're going to see it there, but it is seemingly inevitable at this point that we will see more penetration for this. So you as the advisor should at the very least be cognizant of this trend and how you want to approach it when your clients ask you about it out there. So there you go, listeners. Some takeaways from last year and some things to think about, some thought items for 2023 as well. 2023, maybe, at least according to Matt, no longer the year of garbage. Of course, last year, if there was another takeaway that a lot of people had from that last year, I think, was that it was challenging, even in a down year, to make money on puts. If you bought a, let's say, S&P put, your typical 5% or 10% out of the money put, you did all right in, let's say, the first quarter when we saw some of the sharper moves down. The rest of the year, it was very challenging. We saw markets vacillate all over the place. We saw put skew get bid up and then come crashing in. And if you were one of those people who bought the put when the put skew was very elevated, you found it very challenging to make money on that, even if the underlying did move the way you wanted it to move. So there's a lot of challenges inherent in owning puts, even in down markets. Matt, would you say that's another takeaway for you and indeed for a lot of the listeners from last year, that even in a down year, puts are perhaps more nuanced products than people thought going into it, Matt?
Yeah, and what I've been noticing is in our back test, because we go back and look at, okay, how is 2022 played out? And it's similar to 2018. Some of the strategies that did well in 2018 also did well in 2022. And even 2008, you saw some consistencies there. So some of the things that we're doing is instead of doing a back test and just kind of looking overall how it's done, our back tester goes back to 2007, how it's done overall. We're looking, how is it done in periods of duress, which I think the market has been and will continue to be. So you look for strategies that do well in particular months, in particular periods of months that you think is going to be upcoming. And so, that's one of the things that we've done for clients is said, this might not be the best. We could run thousands of tests, but, this might not be the best overall since 2007, but in the months that we think are consistent with what is going to be upcoming, these are the best back tests to look at. So those are the ways that we're adapting our typical business to this new environment that I think we're heading for, Mark.
Of course, one of the other big takeaways for the year that was 2022, certainly a big talking point on this show last year, was volume. Could it be? Was it a record year? Listen, we'll get to that in a little bit in the buzz. I'll leave you with a little bit of a tease, but spoiler alert, it was certainly an interesting year. And we'll get to the numbers in a little bit. In fact, it's so early in the year, OCC hasn't officially released them to the masses, Liz. We had to go do some digging on our own to determine the final numbers, but we'll have them for you in a little bit on the buzz out there. Before we roll out of the P&L segment, Matt, as I mentioned, we are kicking off the new year. First trading day of the year in the red. Last year was a bit of a weird year, a bit of a very weird year. One of the reasons it was very strange is that we kicked off the year at effectively for vol, we came in at somewhere around a 109. And then we also saw a VIX set its low for the year at the beginning of the year, somewhere around 1630, and then never look back again for the rest of the year. So the first trading day of the year last year was actually a pretty important day. As we're recording right now, listen, like we said, everything's pretty much red. S&P is off fully 1% right now. NASDAQ off about 1 1/3%. Dow closing in on 0.75%. Matt, anything catching your eye out there as we kick off the new year in the anticipated color for this year, which is red, sir?
Yeah, I know. I'm just looking at the vol calculation, and you're right. It's just been it was elevated, and now it's just been coming down and down and down, which is odd. That's a very interesting thing to look at. You'd think again. I think it has to do with this. In a bear market, we're just with so many people positioned for the bear market that I think that the volatility of the implied volatility isn't as high. So I think it's a really good point that you're bringing up. And also I think this is going to affect the types of strategies that you're going to be looking at. Also, skew is very low, meaning puts versus calls. It's a lot flatter than it usually is, meaning the put implied volatility isn't as high versus the call volatility as we've seen, meaning like a 25 delta, or even farther out of the money. That skew is about as low as we've seen it. And again, I think that reflects just that the people are more positioned for a protracted bear market here. So those are some of the observations that I have there, Mark.
All right, we have many more observations in store, listeners, as we keep on rolling here. Really quickly, before we get into some of the other fun things that are on our radar here for the year. Matt, it is the beginning of the year, so we always like to take the pulse of the market with a little bit of a catch-up out there. We do it usually at the beginning of the year and at the middle of the year to kind of see what's going on. Like I said, take the pulse of the market from an overall options and trading and all sorts of perspectives. We like to do that using just some very broad-based tools like Google Trends, see what people think. What are they searching for out there when it comes to the options market? So let's start with the most broad-based of all terms, Matt, which is options itself. Obviously, that can include many different things, not just options trading. So we'll get to that second one in a bit. But right now, the interest for options, remember, if you ever looked at a Google Trends graph, they do it from 0 to 100, 100 being the apex, the peak of interest for that year. Every other point on that graph is usually some percentage of that. Could be 99 all down to 1. And that shows you the level of interest, with obviously 100 being the highest. And right now, coming into the start of the new year, interest in options in terms of Google search, about a 77. So roughly 3/4. That's actually pretty good. The high for the year, 100, came during April of last year, the week of April 3rd through 9th. That's how Google Trends looks at it by week. The week of April 3rd to 9th of last year was the high. So not at the start of the year, not at perhaps during the invasion moment, some of the big sell-offs we saw, but actually April 3rd to 9th, an interesting period. We're actually pretty close to the low. The low came on as a 76 on the week of November 20th to 26th. So we're hanging out near the low levels for the year. But then again, that isn't entirely surprising. We are just kicking off the new year. The end of December is usually a pretty seasonally quiet period for options. So options interest kind of at their nadir right now, Matt. But then again, not exactly unexpected given where we are on the calendar, sir. What are your thoughts?
Yeah, those are actually some interesting points because I wouldn't have expected it exactly there. But, when I used to be trading and I was backed by a backer, and he would always say, in a bull market, there's a lot more interest in options. People are doing well, and they're back then, at least in the early 90s, they're protecting their positions. Now, the times that you mentioned for Google Trends, that's when the market kind of rebounded, and I can't remember. It was almost is this FOMO? Like people thought the market was going to be gone, and then it rallied up. And then those are the high points for the interest in the options term. So I wonder if that has it to do, especially with the people that would be searching that on Google, if it's a FOMO type thing, their fear of missing the next rally, and then they're looking at options in order for a way to position themselves. I don't know, shot in the dark. I'm trying to find some correlation here with the market, with volatility, and with Google Trends, Mark.
Well, let's keep it going. Let's drill down a little bit farther and more into our neck of the woods. Get away from a generic term like options. Let's focus it a bit more. Let's talk about options trading. That's obviously very near and dear to our hearts. Options trading, the high for the year for options trading, Matt, came, interestingly enough, exactly a year ago, the week of January 2nd to 8th of last year. That was the apex of Google search interest for options trading, which is interesting. Maybe given some of those data points I mentioned earlier, maybe not entirely surprising, but interesting nonetheless. The low for the year, the nadir, came that same week as the generic options search term, the week of November 20th to 26th. So that period around Thanksgiving, apparently not a huge time for options search interest. Right now, we have bounced off that a bit. We're about 10 points above that. So the interest right now, Matt, about 58. So hanging out, closing in on 2/3 of the interest we saw exactly a year ago. It'll be interesting to see, Matt, as this new year kicks off, if that search interest spikes up again in the first week of the year, Matt.
Well, you know what it could be too is it looks like earnings, the earnings season and option trading has some correlation. So that would be interesting. So if that's the case, we would expect that to come up. Now with earnings starting in 10 days or so. So I guess that's the correlation that I'm taking out of it, Mark.
All right, let's keep the ball rolling here. Let's drill down even farther, listeners. Let's go to volatility. Volatility, interestingly enough, the high for the year for volatility, again, April, but a different period of April, late April 24th to 30th. It wasn't the high for VIX. I do believe the high for VIX was March 7th. The low, interestingly enough, Matt, nobody cares about volatility to kick off the new year. The low is a 42, and it is happening right now. So we are less than half of the level of interest in vol that we were back in April, Matt. Does that surprise you?
Yeah, not much. As I was talking about at the beginning of the show, I think now with interest rate vols coming down, the overall equity, it does filter into the equity vol. So I think people are less interested in it. You could see a spike on this Google chart right around the Fed. So that's when a lot of volatility came. So I think that we're going to, maybe see less interest in volatility and less volatility, from an already high kind of resting rate as the interest rate vol starts to come down more.
Let's keep drilling a little further with a topic that is very relevant, very near and dear to the hearts of this audience in particular, the old covered call, probably the favorite strategy for advisors using options out there. The search interest for the covered call, again, hit its apex for the year, this time exactly a year ago, January 2nd through 8th of last year. The low, I don't have the exact number, listeners, but it looks like it was definitely below 50 here. And so I'm going to guess around a 46 and maybe a 48. That came on September 18th to 24th. So a different period than what we saw with all the other graphs where the nadir came around the Thanksgiving period. And right now, listeners, we're hanging out at about a 57. So closing in on 60% of the overall interest that we saw back last year. But Matt, once again, we kicked off last year. It was a banger period. Vol was high. VIX was at its low, and at least if you believe this data, Matt, interest in covered calls and indeed options trading was at its apex for the year. So we came out of the gate hot last year, Matt.
So I'm going to make the call that this is very correlated with the market going up. So people are interested in covered calls, after they've had a rally in their stock, and not as interested after the market's down. So this looks like a stronger correlation. That's what I'm going to say. And that makes sense too. So, after a rally, people want to do some covered calls. They search it. They look at some information and then they write some calls against their positions that have rallied. And when it's not, they don't really care. So that's what I'm seeing, Mark.
And let's see what we're seeing next, listeners, as we roll on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report, another segment on this show that was born of the pandemic as we started looking at the impact, or perhaps in the early days of the pandemic, the lack thereof when it came to earnings and volatility and the overall markets. Remember in those early days of the pandemic, listeners, it seemed like no one cared about earnings. They could say pretty much whatever they wanted, and it didn't really have much of an impact on the overall earnings announcement. The vol just came in almost across the board. We obviously have seen a market change in that over the course of the last year, particularly over the last 6 months. Matt, we are just coming off quite the banger of an earnings volatility season. I'll have to go check my numbers to make sure, but I do believe it was perhaps the most impressive outperformance we have seen since we've been running these numbers, Matt. So catch our listeners up. What do we see over this last cycle?
Yeah, it was quite an earnings cycle. What we do, just to catch you guys up, we look at the 6 weeks of the earnings season. So there's basically an October that we're just coming off of. There was one in July before that, April, and January coming up. And what we do is we look at how much the implied earnings moves are over or under the past earnings moves, and are over or under the actual earnings moves, with the thought that if you own a straddle, how did you do? And usually what we'll see is the first week is not very good for straddle owners. Second week, a little bit better. Third week, better. And the fourth week, the best. And then it falls off as interest falls off from there. And, that's what we saw. We had a few outliers in the second week, which I still want to understand. But mostly, if you ignore the second week from last earnings cycle, it was similar. The pattern was similar, but on a higher level than we usually see. And we saw 17% over performance from owning straddles. And now, which is pretty typical, and the look of it is pretty typical, meaning the week 4 was the highest, and with the rest falling off. So that was pretty typical, but this level is a lot higher, and I expect that to continue. However, the initial readings that we're seeing now, it's a little bit early. Next week we'll have a better look at it. But the initial reading that we're seeing for the upcoming earnings is that the volatility is not as high as in October. And this could be because of the Fed, all the uncertainty around the Fed and interest rates and such were causing not only issues with earnings, but forecasted, the way that companies were looking forward to earnings. So what we're seeing right now is a kind of a lower, still elevated, but a lower implied earnings move for January. So not as high as October right now. I think it may play out to be the actuals might play. I mean, that was pretty, as you say, a banger in October, but what we're seeing right now is the implied earnings moves are not going to be as great in this upcoming January mark.
Yeah, that week 2 of last cycle, you're right. That was off the charts, 217%. We've never seen a week like that. So you're right. Maybe some outliers lurking in there that merit further investigation, but still just a crazy cycle. And it should be interesting. I know, Matt, you're mentioning you kind of expect earnings to maybe blow up a bit in terms of just looking pretty disastrous coming into Q1 and Q2. A lot of people are echoing that sentiment. They're expecting a very rough start here to the year. So if ever there was a time, listeners, where you felt inclined, maybe you want to start paying attention to earnings volatility data, luckily for you, because we like you folks, we provide it all for you over there at theoptionsinsider.com. Click on the options news and articles tab so you can check out all this stuff we're talking about here, the earnings move results, earnings season, and earnings trades reports. And because we like you folks, we put it up there all for free. So if you want to see the numbers that we're talking about for last cycle, you want to see what names are pricing in for the coming cycle, a whole bunch more, to go, theoptionsinsider.com is the place to go. As we keep on rolling, listeners, it is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, listeners, it's time to get the buzz. It is a very important buzz segment. This is something we've been keeping an eye on for all of last year. It was one of the big questions of last year. Can we possibly even come close to touching the record amount of volume that was put up by OCC last year? Just for a refresher, listeners, that was within spitting distance of 10 billion contracts, 9.93 billion contracts to be precise last year. It seemed like throughout the year, we were on pace for it. Matt was fading it earlier in the year. I mentioned at the beginning of last year, I've had some of my skepticism beaten out of me now. Of course, we all want options volume to grow. I was kind of fading this volume surge early on in the pandemic, and it just kept growing and growing to the point where I just washed my hands. I said, okay, if folks want to keep trading it, that's great. We're seeing the numbers here in our network, and they kept exploding even more aggressively towards the end of the year. So all the other anecdotal indicators that we have are feeding back into, yes, it was a banger year. Matt, we're doing this show so early, OCC hasn't even put out the numbers yet. The official numbers are not available, but we did some digging, and we do have the answer, sir. What do you think? Do you think we did it? Was last year a record year, yes or no?
It sure feels like it. You know, what you're seeing anecdotally, we're seeing here at ORAT. So I'm going to say, I do fade, all these, all the trading, and I've been a fader right in space. So probably, luckily, you can't trade it. But it just always seems to me like, all right, this year has got to be less than that. And no, it always surprises on the upside, Mark. So I'm gonna say, yeah, it did beat it.
That's a good thing. We're all here in the business inherently bullish and long volume at the end of the day. It lifts all of our boats, Matt. So it's a good thing to have these things continue to resonate with the masses out there. And the answer, Matt, for 2022 is a resounding yes. The folks still love themselves some options, pretty much up on just about every category across the board, everything that OCC clears, with the slight exception of futures. Futures were the one dark spot. They cleared 58.5 million futures last year, 55.1 million this year. VIX futures make up the lion's share of that, listeners. So VIX futures have had a bit of an issue ever since XIV went away. Trying to get some of that volume back. They're hoping the new SVIX was going to be it. Doesn't seem like it's really materializing yet, but that was the lone dark spot, listeners, because everything else across the board was up last year. In 2021, equity options, 9.36 billion contracts changed hands at OCC. This year, 9.59, so already growing there. Non-equity contracts, about 500,000 exactly in 2021. 2022, 721 million. We already talked about the futures. We get rid of the other stuff like stock loan. We don't really care about that, listeners. In 2021, like I said, 9.93 billion contracts changing hand. And Matt, the total for 2022, the mad insane year that was 2022, 10.37 billion contracts. So we have had now, Matt, an official 10 billion contract year. When we hit 2020, Matt, and we hit 7.5 billion, that was already up nearly 2x from the previous couple of years. That already seemed outlandish. When we came close to 10 billion last year, everyone said, including myself, oh my God, what? No, it can't be possible. And the answer is yes, Matt, it is possible. And we have exceeded it last year, almost 10.5 billion contracts, sir. What say you? Diehard cynic that you are you just gobsmacked at these numbers?
It's so high that it's tough to even think about, but, a lot of the technology, a lot of the education, and just the markets and the nature of the beast, and so much interest in it. And I also think the pandemic kept people home and thinking about, what are you going to do? Well, you could trade. So I think all those things together have just rocketed these OCC totals. A lot of it's the technology, though. There's now you can we're building automation that just allows you just to trade a lot more than you used to be able to, and with all the technology in the cloud and the market data and with the brokers. Almost all the brokers now have APIs into their positions and into their trading front ends. So you could, whereas before it was only TradeAir, now almost all of them, even Fidelity, I think, is getting into the API. So they're just creating an ability for programmers or for front ends that handle the programming, like ORATs and like I said, Option Alpha and a few other firms, help the automation and just to get these numbers up. You don't have to. I remember when we were market makers, we were saying, well, if you automate what you for a market maker, you could trade a lot more, and you don't have to make as much on every trade. And I think that's what's leading to these astronomically high numbers, Mark.
Yes, I think a lot of people would have thought and did think that if you had the conditions we saw last year, people starting to maybe go back to work, lockdowns easing, on top of that, a protracted bear market. People often throw out there that options love a bull market. So they thought maybe some of the people who had been attracted by the explosive run-ups of 2020 and 2021, they would maybe leave the options market or they would blow out. A lot of people would have thought those factors would contribute to a down year, but no, listeners. The people have come to the options world and they're clearly here to stay. So that's a refreshing thing. We've seen surges in options volume in the past, and they've frequently been short-lived. This is now running on multiple years, and it doesn't show any signs of stopping. And of course, Matt mentioned new technology. We have new products like these zero DTE contracts. That's obviously fueling a lot of this growth as well. People are now trading SPX 5 times a week as opposed to once or once a month. That's a huge boost to overall options volume. So things like that are going to have a tremendous impact going forward. And it always has an impact, listeners. It's your question. So it's time to roll out the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, and let's just check in with some of our pro folks here. Obviously, it's our first show of the year, so Happy New Year to all of you pro folks out there. Just looking at what some of them are chiming in for in terms of what they're interested in for the new year. Option God says looking at some well-known names like Disney and Peloton, but also searching for some smaller names, hoping to get some good ideas from these shows. So that's what we're here for, amongst many other things. Here, Option God. Frank says he's looking at futures and vol products, and his New Year's resolution is to get into those more this year. Certainly an interesting thing. We just mentioned VIX futures kind of down, but now you have the Spikes futures. You have a few other products, VolQ rolling out more products. Got a feeling we're going to be hearing more about VolQ on the network this year, so stay tuned for that. Nichols says he's looking at options and everything. Nothing is off the table, including indie names, futures, cryptos, etc. So he's going to be slinging options fast and furious on all of the above out there. Intriguing stuff. We've also got a question here. This kind of goes along the line of what we're just talking about here, Matt. This just came in from P&L Man. I see him lurking live in there. So Happy New Year to you, P&L Man. He says, gentlemen, most of our financial prognosticators are predicting a below average year for stock averages. Do you think this will mean an above average year for options trades because there will be an increased use of them to, quote, juice up returns? Yeah, that's kind of what we were just talking about there, P&L Man. In fact, what you mentioned, the below average year, we certainly had that last year. And a lot of people use that as ammunition to say, well, that's going to be a down year for options volume. Options are not going to do as well because they tend to perform better overall from a volume perspective in bull markets than in bear markets. So a lot of people had that factored in last year, and it didn't really come to pass. Again, we saw about a third of a hit in the NASDAQ, around 20% in the S&P. So those are two pretty aggressive down years. And as we just crunched the numbers, options kind of blew the doors off last year. So we already can maybe put a nail in the hypothesis that a down year equals a down year for options volume as well. That's certainly not the case. Matt, as he wants to know, though, do we think this will mean an above average year because there will be an increased use of them? Like I said, Matt, we just saw the numbers for last year. That was certainly an above average year. So I guess P&L, man, this is a long way around to him asking the perennial question, which I haven't even got to yet this year. Do you think we can do it again in 2023?
Yeah, I mean, technology is only getting better. If you think about what some of the reasons were that we're identifying, obviously the every day for the SPX expirations, they can't go much farther with that, as you pointed out. So that's not going to add a whole lot as it did. But I think the adoption will continue with the zero DTEs, and I think the point that P&L man might be making is that if you're not going to be able to make a lot of returns by being just long the market in this bull market, what are you going to do to create some income? And options could help with that. They could also help you, protect or take a more bearish type of outlook and position around that. So I do agree that there are going to be more people coming in and looking to options to augment their portfolio and to protect themselves and to create some income. And so I do think that's going to help. I don't think that we're going to have the tailwinds of the zero DTEs. They're still going to be there, but if we're talking about increasing, I don't think that that was a major thing that was added. So I don't think we're going to get the huge addition of the zero DTEs. Not going to have that big of an effect. And with a pretty major bear market, I do think it's going to be down. Of course, I say this every year, Mark. So, I'm not the person to listen to on this, but I do think it's going to be down because of those reasons.
You've been fading. Like I said, I had my skepticism kind of beaten out of me brutally over 2020 and 2021. I'm now the volume optimist here. Look at this ray of sunshine that I am here. Matt, since we're talking about options volume and the impact of certain strategies, let's get out of here on this one. This comes from The Legist. Interesting handle. The Legist wants to know, has the rise of interest rates made covered calls and other income trades less popular for advisors right now? And if rates continue to rise, do you expect those trends to only continue in the new year? So, Matt, another coming back around to asking about the impact of the current market conditions on certain options trades and, of course, the volume therein. In this case, P&L man was asking about overall options volume. The Legist wants to know, focusing in on the income trades, the volume numbers are there. They speak for themselves. So it's not like covered calls have fallen off a cliff. But Mr. Matt, the Legist wants to know, first off, has the rise of interest rates made covered calls and other income trades less popular for advisors? I think we have the answer to that. And then B, the forward prognosticating part of the question, if rates continue to rise, do you expect those trends to only continue in the new year?
So, and this harkens back to your Google trends. So what we were seeing was just the kind of consistent falling off of covered call searches for 2022, and also when it did spike, it was when the market kind of spiked, and when it did go down, the market went down. So it was pretty correlated with the market. And I do think that the interest rates, it's competition for income producing trades. Selling put spreads are income producing. Selling calls against your position, income producing. So yeah, I do think that the higher interest rates are going to negatively affect the covered call strategy. And, I don't expect interest rates to rise a whole lot more, but I do expect the market to be down. So I do expect the covered call to not be as popular in 2023, Mark.
There he goes, fading volume again. Matt, the infamous volume skeptic out there. Well, listeners, That music, man, time flies when we're having fun here on the Advisor's Option. That music means we have come to the end of our first episode for the new year. Don't worry, a lot more fun in store for you here throughout the year on the old Advisor's Option, as well as a lot of fun in store for you folks out here. Just this week, we were off, obviously, on Monday, but we're back with a gusto Advisor's Option. Obviously, for all you pro folks live today, all you on-demand folks, it'll hit the network later this week. And then, of course, coming back tomorrow, all you live folks get Options Boot Camp. Mr. Dan and I kicking off the new year with that show there. You're also getting Brian coming in. I do believe he's live to tape tomorrow on OPR, as well as a pro Q&A with the greasiest of meatballs. So it's our first chance to check in with him for the new year. If you haven't gotten your questions in, I know P&L Man and others have already sent them in. If you haven't gotten your questions in for the Pro Q&A tomorrow, start sending them in. If you are listening after the fact, use that members hotline. If you're listening live, start getting them in via the live chat. Our producers will collate them all and get them ready for the Pro Q&A tomorrow. But Mr. Matt, we can now let you rest for a little bit. You had a busy end of the year on the network and kicking off the new year with a bang this year. But in the meantime, while you're resting your voice, if folks want to reach out and see what you guys have cooking over there in the land of ORATs, where should they go? What should they do?
Yeah, like I said, our technology, automation, that's really going to be useful, and you're going to have to keep up with the competition because a lot more people are using it. Earnings is coming up. Of course, we have not only the reports that we send out to you, but in our dashboard product, we have a quite good earnings page for each stock, so you can see what the implied earnings is and what the implied earnings moves have been. So come on over to orats.com, try our dashboard product, which is our front end. We have, of course, great APIs that everything's built on, so that's where we keep all of the data, and, of course, our back tester. So my email is matt@orats. You could always reach out to me. And looking forward to a good 2023, Mark, with you.
We're looking forward to it as well. You know who else is looking forward to a great 2023? Our friends over at the Options Industry Council. Check out what they have to offer over there at optionseducation.org. They also have brought back their solo show here on the network, The Wide World of Options. If you have questions about what's going on in the world of options and how you maybe could utilize these products for yourselves or for your clients, check that out. Wide World of Options. You should be listening to the full network anyway, but Wide World of Options, a good companion show to this one here. That is going to do it for the Advisor's Option for our inaugural show for this new year. Hope everyone listening had a great, fun, safe New Year's, and we'll see you back here very soon for the next episode of the Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.